Hello to everyone that has joined so far. I'm going to give it till 12 before I begin, just to let other people enter the room. Okay, it looks like most people are in now, so I'll begin. Hello everyone and welcome to today's webinar. My name is Louisa Gaynor and I'm a Senior Client Advisor here at Netwealth. And today we're going to be looking at how to maximise your wealth to achieve your financial goals. So we're going to be focusing on a number of different things. We'll be looking at tax efficient financial planning, both in the accumulation stage of your life when you're working and perhaps have that excess income to save each month, as well as the importance of being tax efficient in the retirement stage of your life. And there's been a lot of changes to tax legislation in the last few budgets, so I thought we would start off by reminding ourselves of the current tax rules, as well as the importance of utilising our available tax wrappers and allowances each year. We'll also have a look at how in retirement, a thoughtful drawdown strategy can have a very significant impact, not only on the life expectancy of your assets, but also your inheritance tax planning. I'll then provide a quick demo of our online tools, which are free to use and are really helpful in terms of enabling you to track your wealth and visualize your plans through time. And then we'll think a bit more about the investment planning side of things and how putting a robust investment framework in place is really important as well. Hopefully, this will all provide you with a good insight as to how Netwealth approaches these points and can help you achieve your objectives. We've had a number of questions in before, so I thank you very much for submitting those. I've tried to base the topics we're covering today around what was brought up, but as always, if you have any questions or would like to discuss your specific circumstances in more detail, please do get in touch by emailing our advice team at advice@netwealth.com. So I thought to start, we would look at controlling the controllable elements of investing, because this really is done with the aim of maximizing our wealth. There are many things that an investor cannot control, and these are shown on the left-hand side of this chart here. They're the elements of investing that, although we can't control, we can model for them in our plans, and it's really important that we do so in order to get a good indication of whether our goals are achievable. So the first one we can see here is market performance. Clearly, that's something that is well out of our control. However, by understanding how different asset classes tend to perform through time, there are things we can do to manage the volatility and risk within our portfolios. And the next one here is, of course, inflation. And this is not something we can control, as we're experiencing at the moment. And we can see in real time how it does have a real impact on the value of our capital. So we have to factor it into our plans, particularly if we're planning to withdraw cash flows from our portfolios through time. And the last one here is longevity. Of course, no one can ever be quite just sure how long they're going to live for. So the message here is just to understand and to plan for living maybe a little bit longer than you might otherwise expect. The risk here being that you outlive your investment assets. And so it's important to plan accordingly so this doesn't happen. And now looking at the right-hand side of the chart here, and this is what we want to focus on today. So these are the factors of investing that are very much within our control, and therefore, because they're within our control, we should be aware of them and we should do whatever we can to optimize them. And the first one here is time in the market and not trying to time the market. We would never advocate for attempting to time the market. We saw markets drop significantly over the last few years. And if we ask ourselves truthfully, when we were sitting in cash during those times, would we have actually had the confidence to get invested at a time where you would have been buying in at a lower price point? The answer is probably not. So generally, the best thing to do is to think much more carefully about the appropriate level of risk that you feel comfortable with so that you are able to sit through the good times and the bad times in markets, knowing that there will be periods of stress, but making sure that in the long run, you're harvesting those market returns as and when they occur. And the next one on the list here is diversification. And this is making sure that you are exposed to different asset classes with different drivers of return and risk. And that's what our investment team here do on behalf of our clients. They think very carefully about the right way to populate portfolios and how to manage them through different economic cycles and market environments. They try to make sure you're not too overly exposed to any certain investment factors or even too concentrated in a particular sector or region. And then we come on to some of the other really useful drivers of return. And this is thinking about how we structure our investments. So making sure that we're using our tax wrappers and allowances efficiently. So that's our pensions and our ISAs and things like that, which can really help drive better net returns in the long run. And another important factor here that will really help drive better net returns is, of course, the amount of fees we pay, and ultimately ensuring that we're not paying too much in fees. And this is a big part of what we focus on here at Netwealth. We understand the importance of keeping the whole cost to clients right down to a minimum, as they do make a very big difference in the long run. So today we're going to focus on the right-hand side of this chart here. And I'm going to start more with the financial planning elements of things. So looking at the third part here of utilising our tax wrappers and allowances, both in a way that's being thoughtful about the withdrawal strategy on the way in and the accumulation strategy on the way out. And so I thought it would be quite helpful just to begin by reminding ourselves of the current tax rates and allowances. So to recap, firstly on the string budget of last year and paying a particular attention to the changes in pension legislation, what we can see here is that the annual allowance is now £60,000. So that's an increase from £40,000. And that took place with effect from the 6th of April 2023. From the same point, the money purchase annual allowance also increased from £4,000 to £10,000. And with effect from this year, the LTA has been abolished completely, albeit with your maximum tax-free cash entitlement being frozen at 25% of the old LTA, which is 25% of £1,073,100, i.e. the figure that you're seeing here of just over £268,000. For higher earners as well, the income level at which tapering of your annual allowance starts to come into play, has increased from £240,000 to £260,000, with the maximum tapering of an annual allowance increasing from just £4,000 to £10,000. So there certainly are some planning points to be had here, and I'm going to come on to those in a bit more detail in a moment. And more recently, in the spring budget of this year, so in March 2024, we saw Jeremy Hunt say he was going to cut national insurance contributions from 10% to 8%, which will have quite a significant impact on the workforce and should generate up to savings of up to £450 per year. In more positive news, the higher rate of capital gains tax on residential properties was reduced from 28% to 24%. This was really done with the aim of trying to encourage individuals to put their houses on the market. The non-dom tax status was also abolished, and in an effort to inject money into the UK economy, a proposed British ISA was introduced, and this allows an additional £5,000 on top of an individual's £20,000 ISA allowance to invest solely in UK businesses. So you can see here that there is and has been proposed some quite positive changes, and there's some really significant potential planning points in the legislation at the moment. And this has all been taken, this all has to be taken though with a slight pinch of salt, as although this is all quite positive, we have to remember that the current rates and allowances actually remain pretty rigid. And that's what we can see here when looking at the personal tax rates and allowances as they currently stand. So what we're looking at here, firstly, with regards to income tax, is the personal allowance, and that's the amount of income you can accrue tax-free, and this remains frozen at £12,570 per year. The basic rate band threshold also remains frozen at just above £50,000, with the additional rate tax threshold remaining frozen as well at just over £125,000. This means that anyone with taxable income over this amount will have that income taxed at 45% per annum. And the issue here is that although frozen and so implies no tax increases, because the value of wages and assets have increased, it pushes more of us into that higher tax band. So it's what's known as a stealth tax. Looking at the right-hand side here, what we can see now is that the capital gains tax allowance was also cut quite significantly again, from £6,000 last year to just £3,000 with effect from 6th of April. Similarly, the individual dividend allowance was reduced from £1,000 to just £500 in this tax year, and the tax rates and bands remained frozen as they were in 2023-24. Another self-tax to be aware of, and one that you can plan around, is the inheritance tax threshold. So this is what's known as the nil rate band. This is the value of your estate or any chargeable lifetime transfer that can be transferred without incurring an IHT charge. The nil rate band has been frozen at £325,000 per person. And again, while this may seem as a not insignificant amount, when we think about the value of our assets increasing with inflation, it does just push more of this into our taxable estate for IHT purposes. And I'm going to come on to that in a bit more detail in a moment. So although it paints quite a limited picture in terms of what entitlement to tax-free income and assets we have, there are still those that are available, and the planning we can do around it can have a significant impact in the value of our overall wealth if we use them consistently over time. So if we take them one by one, and the first one we're thinking about here is pension contributions. And so for those who now find themselves as additional rate taxpayers, an increased pension contribution can really make sense. We've already run through the changes to these rules, and there are certainly planning points to be had here. So making additional pension contributions would mean that you receive tax relief on the way in. So that's 20% at source and an additional 20 to 25% via your tax return. It's of course important to remember that whilst you're entitled to take 25% tax-free cash on the way out, so that's 25% of the current LTA, the balance will be subject to income tax at your marginal rate. And whilst that may seem quite punitive, actually what you need to think about is that your marginal rate of income tax will likely be considerably lower than it is now, as you would have retired. This is, of course, a complicated area, and the first port of call would always be to check how much available annual allowance you have, whether you're tapered, and if you have any unused allowances from previous years, and whether you're able to carry these forwards to make a larger contribution in the current year. And these are all questions that Netwealth can provide clarity on. We offer a £400 fixed fee pension contribution advice package in which we would confirm the maximum amount you are able to contribute to your pension in any one tax year. And that's factoring in these points of tapering, carry forward rules, contributions already made, as well as relevant earnings and things like that. So if it is something that you would like to speak with one of our advisors about, please do contact us at advice@netwealth.com. The second important planning point here is ISAs. So this remains one of the best ways to shelter your assets from tax. Making the most of you and your family's ISA allowances can have a significant impact on your investments over time. The returns within an ISA can grow tax-free, and unlike with a pension, any withdrawals you make from your ISA are not subject to tax. In addition to this, your capital gains tax allowance is also worth considering. We know that this is now limited to just £3,000, but it's important to think carefully how we can utilise this each year, as if it's not used, it is lost, it can't be carried forward. So at Netwealth, we try to target this specifically. We enable our clients through our online services to harvest their capital gains free of cost. Under your instruction, we can target gains within your portfolio up to available capital gains tax allowance. We would simply buy a subset asset class allocation that would be in a similar risk profile to your existing setup. And after a certain time, we would buy back the original instruments, which would just have the impact of rebasing them at a slightly higher book cost. The aim here being that when you do ultimately come to liquidate the portfolio, the amount that would be subject to CGT at this point would hopefully be managed and lower than it might otherwise have been. And the final one here that we've touched on already is the IHT threshold. So as we already know, this is frozen with the nil rate ban of £325,000. And whilst this may not seem punitive, as I've already said, this increases more of your assets into the taxable environment. And so it's important to think about what planning points you can do here, whether it be gifting earlier, setting up a trust, thinking about family investment companies. There are a number of ways as to which we can remove value from our estate to keep us within the realms of the tax-free environment. But it is a complicated planning point, and it is often a trade-off between tax efficiency and control. So really, I would suggest, again, speaking with our advisors about this and emailing any specific queries you have to advice@netwealth.com. So I just wanted to briefly demonstrate now some of these points in action. So the first being the use of a family ISA and JISA allowances. So in this first chart here, what we're looking at is 500k invested in our risk level 7 portfolio. So that's our highest risk portfolio with over 90% in equities. And as we're investing in a general investment account, any income over our allowances is subject to income tax at 45% if you're an additional rate taxpayer. Equally, any capital gains would be subject to tax at 20% if you are a higher or an additional earner. So looking at that chart, over a 10-year period, this portfolio will grow in value to over £645,000 in average market return scenarios. So still quite an attractive view there. If, however, we look at the right-hand side chart and a scenario where you have 500k in a general investment account still invested at risk level 7, but the difference here is that each year you use that general investment account to subscribe to your family's ISAs. So that's 20k in adult ISAs and let's say 9k in junior ISAs. That 500k can actually grow to £730,000 in average market return scenarios over that same 10-year period. So you can see you are significantly better off by simply investing efficiently and sheltering your investments from tax. Your family's wealth has grown by an additional £85,000 in average market return scenarios. And this next slide here just shows a breakdown of how that actually works in practice. So with the first chart, we're looking at that general investment account worth £500,000, and each year you're moving £20,000 into 2 adult ISAs, so perhaps that's for you and a partner. And then on the 3 charts below, you can see you're also moving 9k per annum into junior ISAs for 3 of your hypothetical children. And this is where that total pot over that 10-year period is then worth £85,000 more. So you can really emphasize the importance here of using your tax wrappers and allowances each year. And so it's important to also think about the decumulation stage of our life. So we've thought about how we could be thoughtful when accumulating wealth, but also from a tax perspective, how we need to be thoughtful about the decumulation stage. So when we're drawing down on our investment assets. And I thought the best way to illustrate this was through a case study. So what we've got here is Annabelle. She's 65 years old and she's just retired. She's got a pension valued at £1 million, which she has recently crystallised and moved into drawdown. She's taken her full 25% tax-free cash entitlement and has reinvested this in a general investment account. And each year she's going to make use of her available ISA allowance from her general investment account. And she also plans to invest all of these portfolios in a globally diversified portfolio with 60% allocated to equities and 40% to bonds and cash. Annabelle's primary objective here is to provide income for her retirement, and then she would also like to pass on any remaining funds to her 3 children. And the income she would like to target is £3,500 net per month. So in this first chart here, we're looking at a drawdown strategy, which assumes that Annabelle will draw that £3,500 net per month from her pension assets until they are completely exhausted, at which point she'll then use a combination of her general investment account and her ISA to meet this income requirement and to fund the remainder of her retirement. And what we can see in this projection here is that it looks fairly good. The thin white line you can see in the middle of the projection shows the average market return scenarios. And here, Annabelle will meet all of her income requirements and will actually have around £330,000 remaining in her investment assets left at the age of 95. And these are all left in her ISA. So if we assume conservatively that her nil rate band has already been used up elsewhere on her property, for example, this ISA will be subject to a 40% IHT charge before being passed on to her children. So it's still a pretty good scenario, but the question here, although a good outcome, is can it be improved in any way? And that's what we're trying to show with this next chart here. In this scenario, Annabelle is slightly more thoughtful around her drawdown strategy and is conscious of her tax position. Here she draws on a blended basis. So Annabelle still has an income requirement of £3,500 per month, but instead of drawing solely from her pension, then her GIs and her ISAs, she looks at a combination of her pension, her general investment account, and then her ISAs. And this has the effect of utilising her full basic rate band each year. Here, she draws on her pension up to the basic rate band and then supplements this with income from her general investment account until it is exhausted, and then from her ISA. And in doing so, what we can see here is that Annabelle has significantly more in her investment assets remaining at the end of her retirement, so at the age of 95. Here she has £655,000 versus the £330,000 we saw in the previous scenario. And actually, what's also improved is that here, all of her investment assets are within her pension, which is outside of her estate for inheritance tax purposes and can pass directly onto her beneficiaries without being held up by probate or without incurring that 40% IHT charge she would otherwise have done. So it is a significantly improved outcome by simply being more thoughtful about how to draw on her retirement assets in a tax-efficient way. And this next chart here is simply designed to show the importance and the impact of fees over time. In this chart here, we're looking at the same scenario as we were in the previous slide. Annabelle is still drawing £3,500 per month in a blended approach from her pensions, her GI and her ISA. But the only thing that differs here is that she's paying 1% more in fees throughout that time horizon. And what we can see here is that that 1% more compounded over time, over that chosen time horizon, means that the funds are being exhausted 4 years earlier in average market return scenarios, as shown in the white line here. So it's really just an illustrative chart which highlights the importance of being mindful about fees over time. And what I want to do now is just change things up slightly and look at our online modeling tools and how these can really help you to visualize your plans and achieve your goals. So what I'm going to do is I'm going to switch to our online tools, which can actually be accessed by anyone who simply registers with us. So they are free to use, and you can register by going to netwealth.com, setting up a user address and a password, and then you get access to these tools here. And I've thought of a couple of scenarios that I wanted to look at, and these are really based on some of the questions that I received in about planning for your retirement and also applying for things like school fees. So first off, if we start with the retirement objective, what we're going to do here is we're going to choose a base study, which is going to be sterling. We're going to stick with our core investment strategy, which is our main strategy, and we're going to look at a retirement goal. So here we've got a client who is aware that in their retirement at the age of 67, they're going to receive their state pension, which will provide them with some of their income. They may also, outside of that, be lucky enough to have rental income or perhaps a DB pension, which will alleviate some of the pressure on their investment assets to meet an income requirement. So what they would like to do from these investment assets here is draw £5,000 per month, which equates to £60,000 per annum. We've talked about the importance of modelling for inflation, so we're going to inflate that £5,000 per month by 2.7% per annum. This particular client happens to be 50 years old, and they would like to retire at the age of 65, so that's 2 years ahead of when they're going to receive their state pension. And again, we've talked about the importance of modelling for longevity. And so we're going to ask their retirement to last them for 30 years, which would take them right up to the age of 95. So whilst it's quite common for most clients to have their assets spread across a number of account types, as we saw in that example of Annabelle earlier, where it's general investment accounts, ISAs and pensions, for simplicity's sake here, we're going to look at just as though everything was in a pension portfolio, although in reality it might not be. We're going to say that this client at the age of 50 has built up an investment pot of around 600,000. So again, that's spread across pensions, ISAs, potentially general investment accounts as well. And whilst they're still working, so for the next 15 years, they're going to be maximising their ISA contributions and their pension contributions. So we've talked about the importance of that. And this particular client is a high earner. So their annual allowance for pension purposes is tapered right down to the minimum, which means the maximum amount they can contribute to their pension each year is £833 per month to get you to that £10,000. And it may well be, but that those contributions are made by their employer by virtue of salary sacrifice, or it may be that they're making those contributions themselves. But it's important that we factor them into the plan. They're also in their own right topping up their ISAs using that £20,000 ISA allowance each year, which equates to £1,667 per month. So their total contributions per month to these investment portfolios is £2,500. And those portfolios are going to be gross, so that's the maximum amount. And then you can see here, we've got the different risk levels that Netwealth offer. So you may be able to align the investment strategies within your own portfolios to one of these risk levels just by looking at exactly what we're invested in. So with the Annabelle example, we looked at a 60-40 portfolio, which is our risk level 5 portfolio here. And by using these tools, you can actually drill down and see exactly what is in each portfolio and how the team have split them between equities, fixed income, alternatives, and cash, and exactly what each position is invested in as well. I'm not going to spend too much time on this now because I am going to come on to it in a later moment when we look more around the investment strategy that we have. But we're going to stick with a 60-40 portfolio for the purpose of this example. So what you can see here is that we've then generated a projection which shows the potential range of performance outcomes given the variables that I've put in here. So to remind ourselves, we've chosen a target income of £5,000 per month, which actually in the first month of my retirement in 15 years' time is going to equate to just over £7,400. And in the last month is over £16,000. So that just shows you the importance of factoring in inflation, because you can see here it really does impact the amount of our income requirement each month. And what we can see is that in strong market return scenarios, which assumes an average annual return net of our fees and net of tax, albeit we are also looking at a pension, so a tax-free environment, that we're going to meet that income requirement, and we're actually going to have about £2.6 million remaining at the age of 95. In average market return scenarios, because the time horizon is so long, it's quite significantly different. We are still meeting that income requirement, but we only have £35,000 remaining at the age of 95. And that's assuming average annual returns of 5.1% per annum. And in weak market return scenarios, the portfolio or the investments last us until October 2053, which is 16 years before the end of our goal. So 16 years before we reach the age of 95. So it's very unlikely that you would experience weak market return scenarios throughout that investment period. But of course, there is investment risk. And so it is important to be aware that that can happen. But we tend to encourage clients to look somewhere between strong and average market returns. And what we're seeing there is a pretty positive image. And so what some clients may look to do is to adjust some of the variables we've included there. That may be adjusting the amount of contributions they make while they still work, or it may be bringing forward their retirement date so they're retiring slightly earlier, or increasing or reducing the amount of income they'd look to retire to target in their retirement. These are all variables that we can change with these performance models, and they're also things that our advice team would be very happy to sit down with you on an individual basis to look through together. So please do contact us at advice@netwealth.com if you would like to do so. But just one more scenario that I wanted to model for based on some of the questions that came through before the start of the session. So it's things like looking at, okay, if I want to fund school fees. And again, this will be done on a case-by-case basis because it really does depend on where you're sending your child to school and how many children you have, of course. But just for illustrative purposes here, if we look at instead a regular withdrawal scenario, and we say, okay, school fees are currently £40,000 per year. So that equates to £3,333 per month. Again, we'll inflate that by 2.7% per annum. And let's say you have a child that's currently 3 years old. You'd like them to start school. You'd like to pay for their secondary school fees, which start in 10 years' time. And that's going to last them until they're 18, in 5 years after that. And this may change. So it may be actually you're looking to just fund higher education, so university fees, or it may be that you're looking to fund nursery fees as well. So there's a lot of variables there, and we can sit down and talk about this on a case-by-case basis. But what we're looking at here is just one client looking to fund secondary school fees. So again, we're looking at using up their pension and ISA allowances elsewhere, and we want to kind of save on drawing on those last because those are our tax wrappers. So any contributions made to this portfolio will be less attractive from a tax perspective because it's going into a general investment account. So the reason we ask here for you to just let us know about your tax rate is because what we'll do is we'll show you the outcome net of tax. So we're going to assume that while this client is still working, they're a higher rate taxpayer. They've got an initial lump sum of, let's say, £70,000 that they're just going to invest. Maybe it's a gift from a parent or a grandparent. Maybe it's just savings that they already have in a bank account. And to this portfolio, they've earmarked £2,500 per month of their salary to contribute to this account to save for their school fees. And again, because they're some way off even starting to draw from it, they may look to take on a slightly higher level of risk that they then may look to reduce down when they start to draw on the portfolio. So if we say they want to look at risk level 6 for the next 10 years, and we click this next button, it's then going to show us a projection where again we're looking at 10 years of accumulating the portfolio, investing it, making regular contributions. Before we hit that point where our child turns 13, we start those school fees, and actually we then start drawing on the portfolio, factoring in those larger withdrawals because of inflation. And what we can see here again is a pretty positive image. So in strong, average, and actually weak market return scenarios, we're achieving that goal. So it may be that we look at actually reducing the risk level because we don't need to take on that much risk, or we look at reducing slightly the amount we're contributing to it each month. So these are the kind of variables, again, that we can factor into not only a retirement plan, but a plan for the more near-term future, things like saving for school fees or purchasing a second home, things like that. So again, very happy to sit down with clients and talk through that in more detail. But for now, I'm just going to go back to the slideshow because I just want to spend a moment talking a bit about our investment approach, as we've had a lot of questions in about how we can actually hedge against risk, against inflation, and how our team actually manage that during the investment process. So what I'm just going to move on to here is talking a bit about the importance of putting a robust investment framework in place and what we do at Netwealth. And so I wanted to start with this slide here, just because I've already mentioned the importance of diversification as being one of the controllable elements of investing. And this slide helps us to think about it in a bit more detail. So what we know is that actually there are a number of different asset classes which have a number of different drivers of return that we can input to our portfolios to help smooth out that investment journey. And this graphic that we're looking at here is something called the market quilt. And we've named it that just because you can see there are quite a wide array of colours. And hopefully the first thing that you see here is that there's very little pattern or order to discern from the colourful blocks. What we can see is that every year from 2007 to the end of 2022, we have ranked the different asset class returns in order of performance. So the higher the asset class appears in one particular column, the better it performed in that particular year. And what we can see is that it's very difficult to know what any given asset class is going to do in any given year. What we can see, however, is that there are certain relationships that hold true between the different asset classes. So if we look at, let's say, commodities, for example, which is in that light grey box there, when that's underperforming and towards the bottom of the page, emerging market equities in the pink box tend to do less well than developed market equities in the blue-greeny box. And that's a theme that tends to run through time. And if you look at it a little closer, one of the most important things to discern from the image is that the white boxes, which say portfolio in them and reflect the Netwealth risk level 4 portfolio, so our balanced portfolio, they land somewhere in the middle there throughout time. So what we've done here is we've simulated the past performance of our portfolio with the attempt to indicate that that box is never going to sit at the top of the chart and it's never going to sit at the bottom of the chart. So it provides you with that level of certainty that you're not going to see these extreme movements in your portfolio returns because you've got a lot of different drivers that are impacting it. And that really is the whole point about diversification. And so how did the team here actually manage our portfolios to ensure they remain globally diversified, whilst factoring in which sub-asset classes to hold within the portfolios at different points of a market cycle? And we would say here that there are three components to the Netwealth's investment approach. The first and biggest is the risk being taken within the portfolios and the returns being generated, and that's being determined by our strategic asset allocation, which you can see on the left-hand side here. So this represents our views of what the best mix of asset classes are for any given level of risk. So if you were to invest in a portfolio and come back in 20 years, this would be our best estimate as to how you should be positioned over that time. In reality, however, we think it's really important to keep a view on how different asset classes are changing. And over on the right-hand side here, we can see how the team think about the cyclical positioning within our portfolios. If we think that there is a given risk embedded within our strategic asset allocation, and we think we can mitigate that, the investment team will act on this. Similarly, if they think there's an opportunity in the marketplace, they may also make adjustments here. And this really is with the aim of smoothing out the path of portfolio return for our clients. And we've briefly touched on the importance of keeping fees down and cost efficiency. And I've already mentioned how this is at the forefront of our minds at Netwealth. And when investing, a key part of this and how we implement it is through our instrument selection. So we primarily use passive funds, so exchange traded funds, which track an indices or a benchmark. And that's instead of trying to pick specific stocks or active fund managers. And that's because this is one of our ways of keeping our costs down to clients. It can still ensure liquidity within our portfolios as well as the desired exposures we're looking to achieve, but all at a much lower cost, and meaning that we can deliver the better net return directly to our clients much faster. And I've had a couple of questions in around the diversification with our portfolios, not just from an asset allocation perspective, but from a currency hedging perspective. And so this bottom chart here indicates that quite nicely. If we just focus on the top chart though for a moment, what we're looking at here is our different risk level portfolios. So we've got risk level 1 all the way to risk level 7 on the right hand side here. And you can see in the lower risk portfolios, these have a higher exposure to assets such as cash and fixed income. But as you move up in risk level and towards the right-hand side of the chart, in these higher risk levels, that exposure reduces in favor of equities. And the team here will be thoughtful about exactly which equities they put within our portfolios and exactly which bond positions they put in there as well. So I had a couple of questions in around bonds, and a recent decision of the team here was actually to forego all bond exposure within the higher risk level portfolios, and specifically risk level 7 that you can see there, in exchange for a smaller exposure to alternatives and a higher exposure to equities as well. And if we jump down to look at that second bar chart there, which looks at the currency allocation, and to those questions then that we had around currency, what we can see here is that when you're looking at a low risk portfolio in risk level 1, you're going to have 100% in sterling. But actually, as you move up in risk level, you're going to have a greater exposure to foreign currency. And that's because we do believe there is a benefit in holding those other currencies within our portfolio as well. But there will be things that the team are being thoughtful about. So, for example, we don't actually currently hold any euros within our portfolios. And whilst we have exposure to European equities, we don't believe there's a current advantage in holding the euro within our portfolio. And so we've hedged that position back to sterling. However, with US dollars and the Japanese yen, we do believe that brings a nice element of a defensive asset class to our portfolios. And so we've left those positions unhedged. You can actually see these exposure quite clearly with our online tools that I demoed a moment ago. And also, if you want to drill down a bit more into that, do just let us know and we can have a further conversation around it. But this is just to give you a bit more of a snapshot into a specific risk level. So here we're looking at risk level 4, and you can see on the right-hand side the asset allocation and also the currency exposure. But quite crucially there as well, on the left-hand side, you can see the instrument selection, and you can see the number of instruments we hold within our portfolios. And that's something that the team will be thinking about quite carefully when they do their due diligence around what they want to put in our portfolios. And that's things that will change over time based on what they believe will provide clients with the best risk-adjusted returns at each risk level. And again, as you saw earlier, using those online tools, you can actually drill down into exactly what is in with each of our portfolios. So I would definitely recommend registering with us at netwealth.com just to be able to even have sight of that. And then again, going back to the questions I've had on bonds, a couple of people have asked about the relevance of bonds within our portfolios and whether there still is place for the 60-40 portfolio for an investor. And I think this chart here shows the value of it through time. So here we're looking at the performance of fixed income in the UK during periods of stress in the equity markets. And we're looking at the years 2004 to the end of 2023. And in each bar here, the area that is blue shows the biggest intra-year drawdown for equity markets in that year. And the area that is grey shows the fixed income return during that drawdown period. And what we can see here is that generally speaking, during times where the equity market comes under stress, the bond market tends to strengthen and therefore mutes at least somewhat the level of loss that we would have otherwise seen across our portfolios. And this is particularly clear if you look in the center of the chart and you're looking at the years from 2007 to 2022. And I am aware and obviously cannot ignore what happened in 2021 and 2022 when we saw those pretty unprecedented times in the market. We saw the relationship between bonds and equities become positive. And in 2022 specifically, as you can see here, we saw both asset classes perform poorly, which had a significant impact, particularly on our lower risk portfolios. And this would, of course, be uncomfortable to see. However, it does not negate the role of bonds in our portfolios over an investment period or a market cycle. The bond market, we think, has actually reset, and the relationship between the two asset classes has started to right itself. And we can actually see that when you're looking at 2023 here in the chart, where you see that period where the equity markets performed poorly, the bond markets actually performed relatively well. And so from that perspective, the concept of a 60 portfolio is certainly not dead in our eyes. There will always be a place for bonds in our portfolios, and it's about being thoughtful about which bonds we use at which points in time. And that's something that is the responsibility of our investment team to review. And this chart here just highlights quite nicely the importance of thinking about diversification, not just from an asset class perspective, but also from a markets perspective. So what we're looking at here is the performance of the US and emerging market equities between, again, 2004 and to the end of 2023. And in the lighter blue line, we're looking at the journey of the US equity market. And in the dark blue line, we're looking at the journey of emerging market equities. And if we focus on the US equity market first, we can see, whilst of course there are knocks, it's a pretty consistent journey up over time. The emerging market equity market, however, is much more volatile. There are often sharp dips followed by sharp recoveries, and the line moves in a very different pattern to that of the US equity path of returns. So what this just hopefully shows is that we never want to be too overly exposed to a particular region, but we recognize the importance of having a measured exposure to a number of jurisdictions within the global equity market. And so that's what the team will always look to do within our portfolios. And finally, just before we close, we've had a number of questions around the Netwealth services, specifically around our fees, our performance, and things like that. So I just wanted to spend some time on that as well. So for background, as some of you may be aware, Netwealth was founded in 2016 with the aim of bringing modern technology alongside the best bits of a traditional wealth manager to deliver a service that was both fit for today and available to many more clients. So we understand that there can be no replacement for people and their expertise, and that still remains at the very heart of what we can do. So we have a team of expert investment managers and experienced financial advisors who manage our investment offering and are on hand to speak with clients whenever they would like. But where we would differentiate ourselves within the marketplace is with our powerful technology, which is designed not to replace these people, but to enhance the client experience simply by increasing transparency and accessibility for clients in terms of understanding their investments and monitoring these through time. The use of technology itself also enables us to deliver this service at a much lower cost, but with no compromise on the quality of it. And I think this can be seen in our track record and the consistent support of our leadership and senior team. And I'm going to come on to the point about our track record in a moment. But first, and because another thing that adds quite a nice tailwind to this is our fees. So what we're looking at here is the cost of our investment service, which includes those points you can see here. So things like investment management, tax reporting, custody and administration, any applicable VAT, and transaction fees and third-party execution charges. And what you can see at Netwealth is we have 4 different fee bands. And the band that you will fall into will depend on how much you and your network contribute to your accounts. So by network, I mean that we have an offering here where any initial investor can invite up to 9 people to join their network. All accounts within a network will remain completely separate and private, but we'll look at the combined contributions across the network to work out which of these 4 fee bands you fall into. So it really helps to drive economies of scale and to help you reach those lower fee bands more quickly. And we offer a cliff-edged approach. So as soon as you fall into one of the lower fee bands, then that applies to the full amount you've invested with us and not just the amount that is above that next fee band. So you can see here, we want to be super transparent about the amount of fees we charge. So the top line shows the net wealth fees, so the 0.75, 0.65, 0.45, 0.35 there. And then the second and third line there show the other costs of investing, which we really conservatively estimate to come in at a total of 0.3% per annum. So your all-in cost of investing are not going to be more than what you see on that bottom line there. And actually, they usually come out slightly lower. And what we've seen is that this has a really big impact on your take-home return and actually the net wealth performance overall. And I've had a couple of questions then around our performance versus our peer group and the benchmark. And so I think this chart here illustrates it quite nicely. What we're looking at is the performance of all 7 risk level portfolios since their inception in May 2016 to the end of April this year. And we can see them in the lighter 2 blue bars on the left-hand side, risk level 1 and 2, and then going along in the darker blue bars towards the right-hand side of the chart there, risk level 3, 4, 5, 6, and 7. And what we've done to provide some context is we've compared them to the ARC private client indices, which is the benchmark most wealth managers compare themselves to. And ARC have 4 categories, which are collated by definition of the amount of equity exposure you have within your portfolios. So what we've done here is we've married them up to the most similar net wealth risk levels. So ARC cautious is similar to risk level 3, balanced risk level 4, steady growth risk level 5 and 6, and equity risk level 7. And what's great to see is that we can see across the board we've outperformed the portfolios. And that is down to the things we've covered off today. So our investment team and how they've managed their portfolios, but also the tailwind we get from our lower fees compounded over time. And I've had a couple of people ask about annualized returns and things like that. And I appreciate that this slide here is quite busy. So I just want to draw your attention to the far right-hand column where you are looking at the annualized since inception returns of all 7 of our risk level portfolios and the ARC private client indices. And what we can see is across the board, and I should say as well, these are all shown net of fees. We have outperformed the ARC private client indices, and actually in our highest risk level portfolio, if you had been invested in since day one, the average annual return for that portfolio is 8.4% versus the 6.4% you would get with the ARC benchmark. And you can see that goes down quite subtly with each risk level as you reduce your risk level. So really what you would expect to see from any portfolio. And just briefly before we end, I know we're slightly over time, so hopefully you can all stay with me. I wanted to touch on our advisory services because we've had a couple of questions in around the cost of advice. So we've talked about financial guidance and we've talked about our investment offering, but our advisory team, who are all qualified financial advisors, are all able to offer formal financial advice as well. And we wanted to provide clients with the flexibility to opt in or out of this service and to opt in or out of it on a one-off or ongoing basis. And these are the fees you can see here for this service. You can also find them online by registering with us. And equally, if you'd like to discuss them in a bit more detail, please do email us at advice@netwealth.com and we can talk through them specifically, the process for advice, and how this may be applicable or valuable to you. I also briefly wanted to touch on our guidance offering, which we've really recently launched. So I've mentioned guidance already and how that is free of cost. And absolutely, we are there to speak to you as often as you'd want to really be a sounding board to your existing plans. But you can also opt in for an annual financial, what we call MOT, effectively just a health check, where you input the information around your investment assets and your goals for the future. And we create a projection, which we then sit down with an advisor and talk to you about. This can be done on an individual basis or with spouses if you're looking to do it on a joint basis. So certainly something worth thinking about. And if you would like to find out more about that as a way just to sound check your plan, but get more confidence that you are on track to achieve your goals, rather than just a simple conversation with an advisor, please do get in touch with us at advice@netwealth.com to go through that. And then finally, just to close, I wanted to remind us of what we talked about today. So we've talked about the key challenges that we face when investing: market performance, inflation, longevity, and the importance of controlling the controllable elements of investing. We've highlighted how you need to be thoughtful around tax efficiencies and building a robust investment framework, and the impact that a good withdrawal strategy, as well as lower fees, can have on the life expectancy of your retirement pots. Hopefully with our online tools, I've also demonstrated how Netwealth can help you really to visualize your financial goals and plan for your financial future. And if you have any questions or would like to consider the Netwealth offering, whether from an investment or an advisory perspective in more detail, please do contact us at advice@netwealth.com. But in the meantime, I just wanted to thank you all very much for your time today and for staying with me to the end of the session. There'll be a short survey afterwards, about 30 seconds long, so I'd be grateful if you could complete that. But otherwise, I look forward to speaking with you, as many of you as possible, shortly afterwards. Perhaps you can email the advice team or we can book in for a one-to-one follow-up. But for now, thank you very much for your time and goodbye.